Welcome back to the overview of my financial literacy series titled What You Don't Know Will Hurt You, which identifies extremely important financial issues that most people are not aware of. My name is Brent Kempton, and this is part 2 of the tax discussion. Next, we discuss investment taxes, which stunt the growth of your investment. The investment tax literacy means understanding that there are 3 times that investments can be taxed. First, as you earn the money to invest. Second, as investments accrue interest. And third, when money is taken out of the investment. The good news is that you are never taxed on more than any 2 of the 3. And that tax sheltering legally reduces it to just 1 of the 3. Less than that will get you free room and board and an orange jumpsuit. Do you know and understand the 3 basic tax structures for investments? The first is no sheltering, or what we call naked. The second is probably the most common for 401ks and is known as traditional. The third tax structure is known as Roth. Here is an example of how they differ. This is built upon a fictitious $50 per month investment. In the non-sheltered plan, there's an upfront tax of $5,712 as the money is earned to be put into the investment. Even though the investment is taxed on its growth over the next 50 years, it manages to grow to over $250,000. Because the investment has already been taxed once at the beginning, that amount comes out tax-free. Next, we look at how the same investment would fare in a traditional tax shelter. Because it is a traditional account, there is no upfront tax and no tax on its increase, so it manages to grow to nearly $900,000. However, because the investment hasn't been taxed yet, there is a tax burden of $143,256 waiting at the end. But the results are still a lot better than in the previous example. The final example is how the same investment would fare in a Roth Tax Shelter. Like the first example, there is an upfront tax of $5,712 as the money is earned. Because the investment is not taxed here either on its growth, it also manages to grow to nearly $900,000. Because the investment was taxed up front, there is no tax burden on the back side. There are several common tax shelters in use. Each has its pros and cons and needs to be understood to know how to best leverage it. Within the area of personal retirement plans, you have IRAs and TSAs in both the Roth and traditional flavors. Annuities are in a world of their own, but can be very useful when done right. You have to work for somebody in order to be able to have a 401k or 403b. There are a lot of good reasons for using a tax shelter, but there is also a dark side that you need to be aware of. The first is that you're not free to just pull the money out on a whim. You will be both taxed and penalized on the money that is pulled out too soon. In addition, IRAs have to be held for at least 5 years, even if that takes you past the 59.5 year limit. The traditional 401ks have their own particular gotcha if you don't pull the money out so that the government can tax it. It's called a required minimum distribution and starts at age 70.5. Because the government is tired of waiting for those taxes, if you don't pull out the required amount when they say, you'll be taxed on that amount plus fined half of it. Well, on that happy note, that completes this session. Our next session will be investment literacy, which identifies aspects of investing that are crucial to doing it the right way. Here is my contact information. You can stop the presentation if you need time to write it down or to click on the QR code. And once again, thank you for listening.